So last week, while discussing financial crisis, we had mostly focused on developing economies. But as we have seen during our discussion of the great financial crisis of 2007 to 9, it's not the case that financial crisis can take place in uh, developing economies as well. So it takes place in developed economies as well, as was the case in the US that we have discussed. So this week, what we are going to discuss are several aspects of financial crisis highlighting things that actually tend to occur both in developing economies as well as in developed economies. And we are going to particularly focus on some examples from Europe to highlight how these channels played out in the particular crisis that we are talking about. So these mainly would concern the events leading up to the European sovereign default crisis of late 2000s. So the first aspect we want to highlight is this effect of capital inflows and misallocation. So what typically happens is that before a crash occurs, usually there is a period in which credit finances investment booms. So by credit, you can think of loans, and investment booms, you can think of building different infrastructure, building different housing and so on, right? So different types of investments that takes place, right? Now, why does such a thing happen? So typically, as we have seen, that poorer regions often have more investment opportunities because they are more low-hanging fruits, and richer regions typically have savers, but not so many different investment opportunities because the easy type of investments that could be made have always typically been made, and now it becomes harder to find good investment opportunities. So as a result of this, because of this imbalance, you typically have capital flowing from developed to developing regions. So this can happen across the globe. So as we have seen before, that in the 70s and 80s, you had money flowing in from the richer industrialized countries to Latin American countries, which led to the Latin American debt crisis. And it can also happen within a trading bloc. So as we'll see, as a result of the European reforms, this was money flowing in from the core regions to the periphery regions. Now, it's not always the case that these capital flows are bad. So they can also have some benefits, as we have discussed. So financial markets become more integrated, economies boom as a result of this investment opportunities, and also typically you have got income growth speeding up in the poorer regions. And so as a result of that, there is convergence across the different regions that happens. So these are some of the good things that happens as a result of this capital flows. But the problem arises from the fact that capital is also allocated between different sectors and firms. And whenever you've got excess capital flow happening, this becomes more of an issue, right? This is because of the fact that in addition to having fewer resources, poor countries are also worse at deciding who to give money to, right? The reason is that financial markets, which are basically the markets you can think of, which allocate capital across different needs, are not open deep enough. There is typically a lot of political interference. Um, this can be in terms of taxing different activities differently in response to political pressure and vote bank politics. There is often regulation and corruption that often ends up favoring different sectors and different particular firms. As a result of that, capital often goes to firms which need not be the most needy firm at that time, right? And it's not only you have got political interference in terms of policy, you also have banks and financial markets also have government problems, and they are typically not very good at evaluating projects in terms of thinking about which projects to fund. So as a result of increased capital inflow, this actually tends to increase the misallocation. So misallocation is always there, but when capital inflow is not so high, typically that is still kind of like puts a limit on how much misallocation happens. But as you have got more and more money coming in from the richer regions, this kind of misallocation problem tends to actually increase. So why is that the case? Because with more resources, bank managers become even more relaxed at screening projects, and politicians become less eager to make economic reforms and to enforce competition policies. So as a result of all of these kind of like changes, productivity tends to fall. So what do we mean by productivity? You can think of this as the most efficient way of capturing how input translates into outputs, right? So with the same amount of machine and workers, you can actually produce different levels of output depending on how productive the production enterprise is. When we say productivity falls, what we means is that at an aggregate level, that the same amount of input is now producing lesser output compared to before. So as an application, let's think about what happened in the European region. So, as we have seen in our previous discussion, in the late 1990s, you had several countries of the European Union coming together and adopting the euro as the common currency. And the goal was to basically deepen the market for goods and services by eliminating the barriers of free flow of capital across Europe, right? So, earlier you had different currencies in different European countries, then you had different monetary policies, you had different interest rate policies, and so on. As a result of adopting the euro, you tend to kind of like get rid of a lot of these hassles to trade, right? So, in particular, the exchange rate risk disappeared. What do we mean by the exchange rate risk? So, whenever you had earlier, let's say, trading between Germany and Portugal, and each of these countries had different currencies, so there was always a concern that, let's say, that you have extended loans to Portugal, but suppose now the Portuguese exchange rate depreciates. So as a result of that, you might end up getting less money compared to before, right? So now that Portugal and Germany have adopted the same currency, so then German investors at least would not have to worry about this exchange rate risk. However, even though the exchange rate risk disappeared, you still had the case that each of the governments were deciding the fiscal policy on their own, right? So how much deficits to run, how much loans to take, and so on. And the risk of sovereign default remained. So remember, sovereign default refers to the default when governments refuse to honor their debt, right? So that is the sovereign default situation we are talking about. So even though you had exchange rate risk disappearing, you still have because the governments were still in charge of the independent fiscal policies, you still have this possibility of sovereign debt reform. However, investors were optimistic and they were willing to lend at low interest rates to countries in the European periphery, which had a history of default and delicate public finances. So, what do we mean by countries in the European periphery? So, think about countries in the southern part of Europe. So, typically, this would be as the countries which the crisis spread. So, think about countries like Greece, Spain, Portugal, Italy, and so on, right? So, what is the significance of the low interest rate? Because they were confident that the risk is not so high. And so, therefore, they were not willing to actually charge a very high interest premium in order to pay this. So, this low interest rate reflects the fact that they didn't consider that there was any significant risk of default. So this combination of no exchange rate risk because of the adoption of euro and close to zero perceived sovereign default led to large capital flow happening within the euro area. So the core regions, which would be, for instance, Germany and France, had a capital current account surplus of more than 600 billion euros in the period 2000 to 2007. And the periphery regions, by which think of countries such as Greece, Ireland, Portugal, and Spain, they had a matching current account deficit, which tells you that basically money was flowing in from these core regions to these periphery regions. Now, the problem was, as we have discussed, that the capital markets and political institutions in these periphery countries actually lacked the capacity to channel these large flows of capital. So even though money was coming in, whether the money was going to the right places was the question, right? In particular, what you had was that construction and wholesale trade sectors boomed at the expense of the tradable sectors, even though the productivity growth was higher in the later sectors. So by tradable sectors, think about goods where the goods that you're producing, they can be exported out. And what was happening was that even though productivity was more higher in tradable sectors, so the tradable sector was much more efficient, more money was starting to flow into construction and wholesale trade sectors because this is where, for instance, the vote banks were and the regulations were more laxed and so on, right? And as a result of that, total productivity, if we think of the weighted average of this productivity across different sectors, which is typically measured by a variable called TFP, which stands for total factor productivity, that stagnated. Okay, so this is graphically showing what was the case. So think about 1998 productivity in that year as normalized to, for instance, uh, sorry, 1999, productivity normalized to 100. So what you see is that before the adaptation of euro, this was kind of like already on a downward streak. But once the euro kind of like was adapted and you had this capital flows, as we discussed from the core regions, that total product TFP, which measures this productivity, actually decreased by a lot, right? And economists were able to kind of like do counterfactual analysis to think about what would have been the actual productivity if you actually still had kind of like the correct allocation of resources both across sectors, right? And also within sectors. So the orange line indicates that suppose you had the between sector misallocation not being there, what would have been the case? And the gray dash line indicates that what would have happened if you had both between sector misallocation not being there and within sector misallocation being there. And we can see that as a result of this, the productivity kind of decreased a lot. Now, why do we care about this? Well, the reason is that if you have a lot of misallocation of capital across different uses, and as a result of that fall in total productivity, that affects how competitive you are at an international level. So that's one thing, that the export sector was actually harmed as a result of this misallocation. But it's not just that the external sectors were affected, right? If you have a misallocation of capital across different uses, that also leads to misallocation of labor. For instance, if you have got too much money going into construction activities which are not productive in the construction sector, so then the wages in the construction sector would go up. And in order to keep up with that, the wages in the other sectors would also need to go up, right? So you can see that basically these distortions tend to spread, right? So as a result of this abundant capital going to the non-tradable sectors, they had to kind of like pay higher wages and attract more workers, right? And this actually ended up raising the cost of firms in all the tradable sectors, because now these tradable sectors also have to compete with these non-tradable sectors to pay higher wages. And so as a result of that, how competitive these Portuguese firms fell. And that led to basically, in the long run, deterioration of the economic conditions. So this misallocation and this intensification of the misallocation due to investment booms is a pretty common factor in a lot of financial crises, especially the lead up to the financial crisis. Okay, the second aspect of financial crisis that often emerges is this nexus between the private and the public sector. So think of this as the connection between the private and the public sector. Now, where are these things connected? Well, because you have got that typically banks and public debt are linked by a large extent. So again, what do we mean by public debt? So this is the debt which is issued by different governments. Now, how are these things connected? Well, firstly, notice that whenever you have got banking crisis, as we have discussed in the previous week's lecture, they often come with large fiscal costs. So where are these fiscal costs coming from? These are typically associated with bailing out these banks, right? And recapitalizing these banks. And also, whenever you have got this banking crisis coming, typically there is a fear that this will spread to the economy. And as a result of that, government often reduces taxes. Plus, because of reduced economic activity, there are fewer taxes going to be collected as well, right? And the governments also tend to increase the payment on different social payments that happens during this recession, right? Because you need to provide unemployment support and so on. So as a result of all of this, the government public debt tends to go up. And this is a phenomena that we have seen over and over again, including during the COVID, that whenever you have got this sort of economic crisis going up, typically governments borrow more. And as a result of that, their debt goes up, right? And once debt goes up, there arises questions of are these countries will be able to actually honor their debt, right? So the not only do debt go up, the riskiness of the debt goes up, right? Now, this is not the end of the connection. The fact happens that banks often actually hold public debt as part of their balance sheet, right? So these bonds that are issued by government, banks often actually have them on their balance sheet. And as a result of that, because the now the public debt is more risky, so the bank's balance sheet is also actually now worse. And therefore, this actually complicates this connection that we have discussed. So notice the direction in which things were happening. Banking crisis leads to worsening of public debt, which leads to worsening of the bank's balance sheet, which leads to worsening of the banking crisis. So one question to think about is that why is it the case that banks hold this debt that is issued by the government? So there are different reasons why that is the case. So in a lot of countries, you actually have financial regulations which force banks to hold a fraction of their assets in safe securities. And government securities are typically classified as safe securities, although as we'll see, they are not necessarily always safe in the sense that there are instances where the government does default, right? Okay. The other reason to hold government bonds as assets is because if the banks do so, then they also make sure that they will have access to central bank liquidity if required in terms of a crisis. And the third reason is that public debt markets in many countries are organized so that the banks themselves are actually the primary dealers of government bonds. So in that case, it would again make sense for the banks to hold national debt. So for a lot of these reasons, you had this case that banks have often a lot of public debt on their balance sheet. Okay. So what is the effect of this concentration of national bonds held by national bonds held by national banks and this government guarantees to banks? So this is the loop that we were talking about, right? So we have already discussed how the banks running into trouble leads to banking crisis, leads to more debt being issued, leads to higher riskiness, which leads to worsening of the banking balance sheet. Let's now look at the opposite side, where suppose that actually investors start fearing that the government bonds are likely to default. Okay, then in that case, they would ask for higher interest rate for these government bonds because if they fear that there is possibility of default, and this increase in interest rates actually leads to other bonds being held by the bank also being worthless, right? So remember the formula for the present value of a bond, for instance, the price of a bond. So the interest rates are negatively related with the price of the bonds, right? So if these things are actually worthless, then that would also lead to banks actually reducing the lending that they were doing, right? So this is basically if their assets shrink, then the banks also respond to kind of like trying to uh, cut down on other ends, as we have discussed before. And as a result of this reduction in lending, that also tends to reduce economic activity, which again leads to further worsening of government finance, right? And this leads to additional strains of government debt, right? Okay. So again, in the first case, we discussed the connection between the banking crisis, how that leads to deterioration in the government finances, which leads to further problems for the banking sector. Here, what we are talking about is that suppose the problem initiates in the case of government default or fear of government default, then that can lead to worse situation for the banks, which can lead to further reductions in lending, which can lead to reductions in economic activity, which can further worsen the government finance, right? So you have got these two different types of connections between these private and public sectors, each of which worsens the initial situation that these entities find themselves in, right? Okay, so what's the connection with the European crisis? So European banks, as we have discussed, had a lot of incentives to hold sovereign bonds because of the reasons that we mentioned in the slides. And sovereign bonds were typically treated as fully safe by regulators, even when the country's fiscal situation was such that the governments were near declaring bankruptcy, right? So the public debt market of each of the individual sovereign, particularly for smaller countries that we have been talking about, were not very liquid, right? And also, in this kind of situation, we have discussed that one of the instruments that the government has in order to prevent banking crisis to take place is that they can often provide guarantees, right? However, the guarantees that these governments were providing to the banks were somewhat not very robust, right? The reason is because banks in European countries often had assets crossing borders. And whenever you've got this across border flows, as we discussed, then the commitment of the sovereign to bail out banks becomes less credible because are you just going to bail out the banks which are within your country, or are you also going to bail out the banks which are in different countries, right? So what that meant was that large amounts of public spending had to be committed to bail out even one bank. And typically, these banks didn't have large amount of money available in the first place, right? So the public finances of the countries were not in good shape. So this is actually an interesting figure, which shows how the European crisis actually started spreading. So this actually has two countries. So the red uh, curves, there are two red curves, the dotted one and the solid one. They represent what are the interest rates being charged in the Greece banks case, as well as the lending that the Greek government was taking at that point. And the blue lines correspond to the situation playing out in Ireland banks and as well as by the Ireland government, right? So you have here CDS spreads. So think about this as something that reflects the interest rate that these people who are giving loans are charging to these entities, right? And an increase in the CDS spread, you can think of this as basically due to happening because of people's fear that the loans may not be honored, and so therefore they are asking for higher interest rates in order to make up for the risk of lending to these entities, right? So what you observe is that uh, in the early part of this graph from January 2007 to January 2008, the situation was fairly stable, right? So you had that both the Greek bonds and the sovereigns, Greek banks and sovereigns being charged very little CDS spread. And similarly, the Irish government was also not being charged a very little CDS spread. But over time, what you observe is that for all of these different entities, the cost of borrowing actually went up. And this was due to the fact that the investors started considering that the loans that they were extending to these entities were more and more risky, right? So you can see that this goes up from almost 0% to close to 10% for different entities, right? Now, although this is the case for both Greece and Ireland, the story is somewhat different for these two countries. And you can take a look at that by looking at the graph. So if you notice that in the Greek case, initially the problem started happening in the government sector. So initially the interest rate actually increased for the government bonds in Greece. And it was only later on that that situation spread to the Greek banks as well. So in this case, what was happening is that it was the Greek banks, the Greek government, which had got into trouble initially, and as a result of that, the banks also got involved, right? So in terms of the situation, this is more the situation that played out in the Greek case, right? So initially there was a worry of the default risk on the government bonds. Then kind of like investors realized that as a result of this, the Greek banks are also in trouble. The Greek banks cut down on lending, and less lending led to reduction in economic activity, which further worsened the Greek debt situation, right? So you can see initially the problem was in Greek government that spread to Greek banks, and later on, kind of like both of them were more considered risky, and so therefore the interest rate went up for both of these entities. In the Irish case, the situation was somewhat different, right? So you can see here that actually the problem started happening in the from the Irish banks perspective, right? So the interest rate in the Irish banks went up, and as a result of that, you can see that there was quite a bit of difference. And it was only around 2009, late 2008, early 2009, that you have that the Irish interest rate on the government bond also starts going up, right? And as a result of that, here the problem was more starting in the banking sector, and then the problem spread to the basically the sovereign sector as well in Ireland, right? And you ended up with a situation where both of them again had to pay high interest rates in order to actually get the loans. Okay, so that was this problems that arises because of the connections between the public and the private sector. So, and the third aspect that we are going to focus on is this phenomena called flight to safety, right? So, an interesting feature of this financial crisis are that as interest rates across sectors and regions increase, as you can see, this is one such phenomena. The interest rates in some classes and regions actually become unusually low at the same time, right? And why does this happen? This happens because you have typically got this flight of capital to safety, right? So whenever you've got situations where certain assets become risky, investors often move by liquidating their positions in those assets and move towards assets that they consider safe, right? Because you have got a lot of money flowing in towards those assets which are safe. So therefore, the price of those assets are going to rise, and therefore the interest rate of those assets are going to fall, right? Now, for most financial crises, what usually this means is that you have got a movement, for instance, away from the stock markets towards government bonds, which are considered safe. But in this particular European case, it was not the case that there were like government bond which was considered safe, right? Remember, as we saw, that the problem was happening from these countries in terms of like risk associated with the government bonds, right? So what happened here was that it was not about risks about asset classes, because you had both public and private sector being in trouble in these periphery regions, right? So we saw the figures for Greece and Ireland, and so the worry was about this kind of like regional defaults happening place, right? So here, flight to safety took the form of cross-country capital flows. So during this Euro crisis, the yield on government bonds in the core countries became historically low at the same time as you have this interest rates in this country kind of like going up, right? So this also actually leads us to think about, okay, whenever you've got this flight to safety, you think about investors basically at moments of trouble want to actually switch to moving towards safe assets. And we have been thinking about safe assets quite a lot in our course, right? But that actually makes us think a bit more about what do we actually mean by safe assets, right? So there are different characteristics that are associated with safe assets, because it's not just enough to say a government bond is a safe asset. As we have seen during this crisis, government bonds can be perhaps be the source of the risk as well, right? So what do we mean by so safe assets? Well, safe assets should have limited risk in the sense of giving its holder the same payoff across a wide variety of possible future scenarios, right? That's the more typical meaning of safe assets, right? So it's also about having high liquidity, right? Especially when you have got the economy is in crisis. Are these assets going to have lower risk and high liquidity in those particular situations, right? And the third thing to note is that oftentimes the safety status of an asset is self-fulfilling, right? As we have discussed during these bank runs and as well as exchange rate crisis, often an asset is safe if it is perceived by all to be safe, right? Compare this with the situation that a bank is safe, it is perceived by others to be safe, or a currency is not in trouble because others do not anticipate any problem with the currency, right? However, if everybody suspects that a bank is about to fail, then the banks may actually end up failing. If everybody suspects that the currency is about to devalue or depreciate, then the currency may end up being depreciating. And similarly for the assets, right? If everybody considers the asset to be risky and starts selling it, then that asset would also probably be in trouble. So this is again another interesting figure which actually reflects what we have just discussed right now. So this has the basically again the 10-year sovereign yield. So think about the interest rate on the 10-year bond being issued by the government. And you can see that initially beginning from 1999 till around uh, 2008, you had that the interest rates issued by governments in the core region and the periphery region were very close, right? So you can see that these two curves actually overlapped a lot. Now, beginning in 2009, you see this difference taking place where the interest rates in the periphery region starts going up because investors start fearing more that this is becoming risky. So this is, we saw particular illustrations of that for these two countries here, right? The dashed red line and the dashed blue line, for instance, that you see here. And the other interesting thing is that at the same time as you have got that these interest rates were going up, you had that the interest rates in the core regions actually started going down, right? And this reflects this flight to safety phenomena that we just mentioned before, right? So that is why you had got like this difference kind of like opening up. And even once this interest rate actually started coming down at the end of the crisis, you still had these actually still remaining low, right? So what explains the gap in the interest rates between these two regions? Well, there can be two sources of risk, right? One is the exchange rate risk. Now, people thought that from 1999 till 2008 that, the euro is here to stay and there is not going to be any chance of these countries leaving euro. So there is no exchange rate risk, right? However, during the height of the crisis, a lot of countries started speculating that perhaps some of these countries in the periphery region will actually end up leaving the euro and that they will have to depreciate as a result of this moving out of the euro, right? And so then this exchange rate risk started actually also arising during this period, right? And of course, the second source of risk, as we have been discussing, is that the periphery may be more likely to default than the core. And as a result of that, investors may be actually asking higher interest rate, right? So although we discuss these things in terms of data from the European region, as I mentioned, these are pretty common phenomena that takes place in a lot of financial crises. So if you are interested in reading more about the financial crisis, one book that can be serving as a useful reference is this book called A Crash Course on Crisis, written by Marcus Brunemeyer and Ricardo Reis. And if you particularly want to look at the European scenario, which is this lecture is based on, you can take a look at this manuscript called A Crash Course on European Crisis by the same set of authors. And this is actually available online for free. So you can either search for it with the title or you can click on the online written here. So that is actually a hyperlink and you can get more details about different aspects that played out during this European crisis. So that you can appreciate more of like how these concepts that we have been studying can be used to think about the financial crisis.